Why we should be worried about Alan Greenspan's negative interest rate prediction. It might mean the end of capitalism. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government. DailyTorch.com. Hit that subscribe button. Today, we're going to be talking about negative interest rates and what it could mean for the future. This is basically the idea that instead of owing interest when you borrow money, either through a mortgage or a credit card, or even a government that's borrowing money on financial markets, you would actually earn interest for borrowing money. And so it's the opposite. And I think that this can create a lot of perverse incentives. It might disincentive if it were carried out across the board, where there's negative interest rates, even for personal consumers. It would disincentivize working. It would incentivize taking out a lot of debt, living in a bigger house, and earning more interest as a form of income. And it can lead to, I think it can have a lot of negative consequences on a productive economy, and impinge upon growth. And so we're going to get into this a little bit. So while financial markets and political media and financial media have been panicking over the 10-year, 2-year Treasury spread inversion, which a good reason for is because we're near the end of the business cycle. But also you have really low interest rates right now. And so one of the consequences of heading towards the end of the business cycle is the Fed is going to start easing interest rates, and they have started that cycle. And that this is going to have put downward pressure on interest rates. And so when you have less growth and less inflation, you get lower interest rates. And we've been seeing those trends for more than 30 years now. But looking at Alan Greenspan, he's the former head of the Federal Reserve. He's talking about negative interest rates. And what he told Bloomberg News in a phone interview is that, quote, "There is no barrier for U.S. Treasury yields going below zero. Zero has no meaning beside being at a certain level." So that's what he says. He's noting the fact that interest rates are very much set by markets. There's a limited supply of Treasury bonds, and so the greater the demand, the lower the interest rate, even as the price is going up. So there's a inverse relationship between interest rates and the value of bonds. So if you bought a bond yesterday that was worth was yielding 3%, then interest rates collapsed to 2%, that means your 3% bond is more valuable. So the price goes up. That's how that works. Now, in the zero bound situation, when interest rates are approaching zero or near zero rates, one thing that central bankers have been discussing for some time now, many years, is the idea of negative interest rates as an adjustment mechanism. And so there's a proposal to either allow Treasury bonds to go negative or to implement negative interest rates on a more broad level beyond government bonds. But basically it means that if you own U.S. Treasuries at a -8 rate, you'd have to pay for the privilege of buying the government bonds. So instead of earning interest, holders of U.S. Treasury would actually owe interest back to the federal government. The federal government would earn revenue from that interest. So who would want to do that? What would be the circumstances where you would want a negative yield on an investment like a U.S. Treasury bond? When there's other asset classes like equities, stocks, that would presumably have a positive rate of return. And so the better question might be, under what circumstances would holding a negative rate bond be a good idea? So I think to explain this, you want to look at situations where in the opposite situation. So when there was high inflation in the 1970s and the 1980s, the reason to hold interest bearing bonds, U.S. Treasuries, was because interest rates were offsetting the inflation. So in a deflationary environment, the reason to hold bonds would be at negative interest rates would be because the asset prices decreases on elsewhere would be even worse. So look, here's an example. If inflation was at -4%, you're in deflationary territory, but you hold a -2% bond, it could make sense to hold it to offset the deflation. Or if you purchased a bond with a negative 2% yield, and then the rate drops to negative 3%, then you can make money by selling the negative 2% bond because it had increased in value. Now, institutions that buy and sell bonds routinely and do not necessarily hold them to maturity. So negative interest rates are a way to remove the maximum price caps on positive yielding bonds. So if you were to buy a positive yielding bond today, and then negative interest rates were to go negative at some point in the future, your positive interest yielding bond would be even more valuable because the whole world is chasing yield. And so that doesn't seem like a very good place to be. Why would we want to be in a situation where prices are basically dropping for asset classes like equities or home prices? We saw that in 2008. Do we want deflation again? We saw deflation in the Great Depression, and it didn't turn out really good. It meant much higher unemployment. And I think we're looking overseas, we can see countries that are already dealing with this. So Japan, they currently have a negative treasury bond. So does Germany. And what are they seeing? They're seeing lower growth, slower growth, and they also have aging demographics that factor into the slowdown. And even in a contraction of the working age populations that can harm growth, and they are, in fact, deflationary. So in the U.S., I think with our aging demographics and lower fertility, we're running into the same problem. So we're not too far behind where Japan and Germany and Europe are in this regard. So if interest rates are going negative, what is it forecasting but slower economic growth or no growth at all, low inflation or even negative inflation, and so forth? Unemployment can tend to spike in these deflationary environments. So if Alan Greenspan is predicting negative interest rates, he must also be predicting that we're going to be seeing an environment like that. That sounds like a pretty nasty recession. So, but the reason to do negative interest rates is, if there is one, is because the deflation that is being projected is unavoidable, and this would supposedly be the only way to incentivize continued purchasing and jump-starting spending. So far, negative rates, interest rates have only been applying to government bonds, but it's starting to expand outward. But if focusing on government bonds, one way to make the government bond purchases profitable, even in an inflation-neutral environment, would be if a financial institution were to borrow money from the central bank at a negative rate to make the purchase and be paid interest in doing so. So say you're a bank, you borrow at negative 4% from the central bank, and then you buy a bond that's at negative 2% interest rate. And so in the process, you would actually earn 2% for basically from borrowing from the central bank. But in theory, you could go even further and do the same thing on a consumer level, where banks could borrow at the discount window and lend it to individuals for mortgages, credit cards, and so forth, and then make money on the carry trade. That could incentivize borrowing at the consumer level, since you would earn interest too. So you would have an incentive to go out and buy a home or get an expensive college education because they'll pay you to do it. And then when you look at how amortization works when you get a loan, say you're paying at first more interest than you are paying principal. Well, if you're at negative interest rates, you could be earning enough interest for having borrowed to pay off the principal that is owed. And so you could live in your house basically rent-free, or go to college and never have to really pay back the loan, at least until the principal's due halfway through the loan, and then you start owing principal towards the end. So this is through the looking glass. This is an upside down world. So if all interest rates were to go negative, it would be helicopter money. The central banks would have to print money for interest payments to banks to pass on to consumers who are engaged in borrowing, just to incentivize the practice. And so what would that do? You would disincentivize working for a living and instead advising going really deep into debt and simply consuming. Again, that doesn't sound like a good place to be. In every case, besides borrowing to earn interest, then the incentive would be to hoard cash. So leaving aside the perverse incentives of earning interest for borrowing, there's also a problem where people are going to want to say, I'm not putting my money in a bank account that's going to have negative interest rates. So you might want to hoard cash. But some economists are already looking at that problem, and so they've come up with a solution. Some say to ban cash. Others, like Andrew Lilly and Kenneth Rogoff of Harvard University in an April 29 paper, call for at least banning larger denomination bills. And so I'll include the discussion that they speak on here. There's in fact a straightforward way to essentially eliminate the hoarding problem without any change to the issuance of paper currency. It basically involves steps so that electronic currency becomes the unit of account and creating a crawling peg between electronic currency and paper currency. If central banks foreclose the hoarding option, it goes a long ways toward enabling private banks to directly pass on negative rates to large-scale depositors. It is straightforward to shield those who hold only relatively small bank deposits, who can constitute the vast majority of retail customers. There is a complication, admittedly, to the Eisler plan, having to do with the fact that paper currency and electronic currency are not perfect substitutes, and the political economy of what is an effective tax on currency, albeit so is inflation. Fortunately, these complications should be increasingly easy to navigate as paper currency becomes further marginalized in legal tax-compliant transactions, outside low-value transactions, and as countries deal with financial inclusion. So phasing out large denomination notes, which for most countries mainly serve to fuel the underground economy, would immediately provide greater latitude for negative rates, even without implementing a dual exchange system, due to greater transportation, storage, and handling costs of smaller notes, and should be considered in most countries regardless. So basically, it's phasing out paper currency. So you're not going to hoard cash because governments will just say, we're not going to do that much large cash denominations anymore. No more $100 bills. Sorry. But in looking at this, though, what are we? I think we're really talking about the symptoms of the underlying problem. So just as hyperinflation, Weimar Republic, or the great inflation of the 1970s and 80s is a problem of too much money chasing a money stock, chasing too few goods, deflation is the opposite problem. It's a problem of not enough money chasing too many goods, causing prices to drop. Then purchases are forestalled, and you can have problems like the Great Recession, where home prices were dropping, or the Great Depression, where deflation was a huge problem, unemployment spiking, and the economy doesn't grow under those circumstances. But really, interest rates are a symptom of these disorders, but they're not the cause. So when the 10-year, 2 years inverted, that's not because that's not the cause of an economic downturn. It's symptomatic that you're nearing the end of the business cycle. As the long rate gets lower than the short rate, and there's a flight to safety going on. So they're symptomatic. And negative interest rates, if implemented fully, well, let's talk about higher interest rates. So in inflation, when you have higher interest rates, that's because they're going to be there to soak up the additional currency, and that will supposedly soak out the inflation. Negative interest rates, if implemented fully, could do the opposite by adding money to the economy in deflationary circumstances, by paying out interest for borrowing. Neither address the root cause, though, either having a currency that is too weak or too strong, but the purpose of central banks is to address inflationary or deflationary forces utilizing interest rates as a policy tool. So there's a preference. Those who are promoting negative interest rates, they're saying this is the best way to do it. You can use these interest rates to soak up too much inflation, or negative interest rates to produce money by paying out interest. But in the case of negative interest rates for government bonds, what markets are saying is that there is too much currency chasing down the asset, which is driving interest rates lower. The market wants more bonds. The dollar is the world's reserve currency. 62% of of central bank reserves are in dollar-denominated assets, and so that's a big deal. China hoards U.S. Treasuries, Japan, South Korea, everyone that has a surplus from trade exports. They tend to invest them in U.S. Treasury bonds, and it's because the dollar's that's why the dollar's the world's reserve currency. It's what it means. Because we're the reserve currency, this dictates a higher demand for U.S. Treasuries, which central banks tend to stockpile, and that has helped drive interest rates to their currently super low levels of the past few decades. This in turn incentivized deficit spending in order to produce more debt, so there are more bonds to purchase. So even with a $23 trillion debt and almost a $1 trillion deficit that we're going to see this fiscal year by September 30th, the rates are still plummeting, and now policymakers are signaling that they might be allowed to go negative. And so this is all symptomatic, is that there's not enough dollars in treasuries to meet current demand. That's why interest rates are dropping. That's why they could go negative. So what do you do about this? It seems to leave a few options to restore normal inflation and keep the economy growing. On one hand, policy makers want to say, let's do negative interest rates. That'll be a cure-all. But over the long term, I think it's really conceding to deflationary forces that are present, that are causing the negative interest rates. And that could lead to dependency on helicopter money or universal basic income to sustain the population. You'll have to print money and give it to people just to keep consumer purchases going and for people to be able to make their rents and everything. In the meantime, you'll be disincentivizing work, and that's going to harm production. So you're going to get less economic growth with negative interest rates. That's what I think. Interest rates are projecting future growth, and if they're negative, you're looking at recession, and if they stay negative, you're looking at a permanent recession. Japan has barely grown its economy in the past 20 years. Now they're pushing for negative interest rates, and I don't think it's helping the economy all that much. I mean, there's the aging demographics there that are very much contributing, and it should be addressed. We don't talk enough about the below 2 live births per woman problem, but it's going to be a problem. It's going to be an impediment to economic growth. So we need to have more kids. That's that as a society. It's going to be a negative drain on growth, and negative interest rates are merely going to be a symptom of that wider problem. Now, on the other hand, besides negative interest rates, policymakers might choose to go with a robust Keynesian fiscal stimulus. So you could talk about like vast infrastructure projects, national industrial policies, or war, and then a combination with tax cuts in order to stimulate spending and government debt creation and producing more dollars to meet demand. But advanced economies are already producing too much debt, and economic growth is not keeping pace. So if we continue growing the national debt, currently at $22.3 trillion, but the economy grows at its current rate over the past 40 years, you're going to see a national debt of 200% debt to GDP, over $100 trillion by 2037. Nearly 200%, 193% debt to GDP. So deficit spending and just trying to grow the amount of dollars in treasuries that way, it could bankrupt this country. I mean, wouldn't that eventually increase the risk of default if we have too much debt? And are those the only options, really? We have negative interest rates on one hand, and a printing press welfare, universal basic income, and that seems to destroy capitalism, or massive government debt creation that wrecks any pretense to limit a government and risks, national default. Neither one of those sounds like really great options. So again, at the center of this debate are the symptoms. We ignore the root causes that are monetary. There's a global shortage of bonds and currency, not just in the U.S. dollars, but all of these bonds and currencies. Why are rates negative in Japan? Because there's more demand for the bonds than there is a supply. Same thing in Germany. And if we're going negative, we're going to have the same problem too, even though we have $22 trillion of debt. So what are these root causes? Let's talk about monetary policy. The U.S. and China right now are discussing a potential trade deal, and that includes a monetary component. China uses an artificially low fixed monetary peg to the dollar to maintain a devaluation against the dollar. And as a result, they've been able to boost exports, and now they have over 16% of global manufacturing market share. Other countries, too, use competitive devaluations against the dollar to boost exports, making the dollar strong in comparison, and then they purchase treasuries with those surpluses, and that contributes to the global shortage of dollars as assets, as they're hoarded in the chase of yield. And so what can we do here? Well, we should probably come up with an international monetary accord. We need to have this discussion with our trading partners. If rates are going negative, if the dollar's too strong, or if other currencies are too strong, well, that's a problem. Let's address that. Let's have this discussion. And I'll leave you with the close here. Negative interest rates or massive deficit spending might appear to be the cures to these troubles. But the best option remains for President Donald Trump and Chinese President Xi Jinping to and their teams to sit down and hammer out an agreement addressing currency valuations and the incentives that they create while we still can. What is really needed is an international monetary accord that can address these disorders for the time being, taking into account current global trade flows, and to deal with the imbalances that have been allowed to build for decades before we wind up in a situation that sweeps out of control and neither side can talk. How the U.S. and China and other developing countries come to terms on currency in many ways is going to dictate how we deal with the implications of those decisions. The solution is to address the root monetary cause and with an international monetary accord. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.